silver trades at $67 per ounce. Not a peak, a rupture. Physical inventories on COMEX have collapsed 70% from 346 million ounces in 2020 to barely 80 million now. London vaults report historic lows, with lease rates spiking to 39%. Borrowing costs that signal outright scarcity, not market efficiency. Indian funds suspend inflows because metal can't be sourced. This isn't volatility. This is the paper facade cracking under physical demand that exceeds global mine output by 400 million ounces annually. The system, built on infinite stockpiles, now exposes its finite core. Deficits have accumulated 800 million ounces since 2021. Nearly a year's production vanished into solar panels, EVs, and circuits. And it's accelerating. Look at the mismatch. Mine production stagnant at 820 to 850 million ounces yearly, while demand hits 1.2 billion. That's no equilibrium. That's erosion. For 5 straight years, we've consumed more than we extract, drawing down reserves that were supposed to buffer any shock. But these aren't buffers anymore. They're signals of structural failure. Primary silver mines account for only 25 to 30% of supply. The rest rides as byproduct from copper, zinc, lead operations. When those base metals don't justify expansion, silver output flatlines. Higher prices don't summon more metal overnight. This rigidity exposes the first fracture, a commodity tethered to unrelated cycles, now straining against its own essentials. Interweave this with history, and the pattern sharpens. In 1980, silver hit $49.45 nominally. Adjusted for inflation, that's $140 to $185 today. But that was artificial, driven by the Hunt brothers hoarding 100 million ounces, leveraging futures until exchanges rewrote rules and triggered Silver Thursday's 50% crash in 4 days. Speculation imploded because it lacked foundation. Fast forward to 2011. Silver touched $48 on post-crisis fears and Fed easing, then cratered below $14 by 2015 as stimulus tapered and economy stabilized. Again, speculative froth without roots. Today's $67 isn't that. It's rooted in industrial consumption that's irreversible. Solar alone projected at 261 million ounces for 2025, up from 60 million in 2015, despite thrifting from 500 milligrams to 111 milligrams per cell. Efficiency gains swallowed by scale. Global installations racing toward 500 gigawatts annually by 2030, demanding up to 41% of total supply. This where the logic breaks. Past manipulations held prices down when vaults overflowed. Documented. JP Morgan's $920 million settlement in 2020. The CFTC's largest fine ever at $436 million, plus $311 million restitution and $172 million disgorgement. Traders spoofed markets from 2008 to 2016, placing thousands of fake orders to shift prices short-term for profit. Not a perpetual suppression scheme, as courts clarified, but real deception. Greg Smith sentenced to 2 years, Michael Nowak to 1 year and a day. Convictions across banks, Bank of America, Merrill Lynch, Deutsche Bank, others, totaling 10 traders jailed. This worked then because physical abundance masked the games. Now, with 800 million ounces deficit, paper tactics hit a wall. The control mechanism that stabilized for decades? Obsolete. If you've tracked bank behaviors in metals trading post-2020, how does this shift look from your vantage? Share your observations in the comments, especially if you've seen lingering patterns or clean breaks. Geopolitics amplifies the strain. China, the largest processor, banned silver exports, locking away swing supply that once moderated Western prices. A deliberate move for supply security amid their 45% solar capacity surge in 2024, bolstered by $10 billion subsidies pushing consumption another 5%. India mirrors this. Jewelry and investment demand surges as incomes rise, with silver ETFs inflows tripling golds in 2025. Some funds returning over 100% year-to-date. Emerging markets aren't peripheral. They're core consumers now, pulling metal from global pools. Add the U.S. designating silver, a critical mineral this year, alongside rare earths, for national security. This isn't rhetoric. It's acknowledgement of vulnerability in tech, defense, energy chains. Military applications lurk here too. Silver in high-frequency gear for 5G, sensors, antimicrobial tech in medical devices. Disruptions ripple beyond finance, into logistics, where data centers for AI demand silver for thermal management, and EVs require 25 to 50 grams per vehicle, 2 to 3 times more than combustion engines. Automotive sector alone, 80 million ounces now, climbing to 90 million by 2025 at 15% growth. Monetary policy pours fuel. Federal Reserve's third rate cut this year to 3.50 to 3.75% range, plus $40 billion in Treasury purchases, a mini QE after ending tightening in mid-2022. Inflation lingers above 2% target through 2028, eroding real yields. When bonds yield 3.5% against 3% inflation, opportunity cost for holding silver vanishes. Precious metals thrive here. Gold up 60% to $4,300, but silver's 120 to 127% from $29 start of year outpaces it. Gold-silver ratio compresses from 80 plus to 65, signaling silver's catch-up volatility. ETF inflows. 95 million ounces first half 2025. Total holdings 1.13 billion. This liquidity flood isn't abstract. It's wealth shifting from paper to hard assets, as seen in 1970s post-gold standard or post-2008. Currency debasement drives it. More dollars chase finite metal. But rewind to causes buried in symptoms. Those lease rate spikes to 39%? Not random. Physical tightness, where borrowing costs scream shortage. COMEX shut down for 10 plus hours recently, amid massive Stanford delivery orders, widened bid-ask spreads, and spiked prices. Technical glitch or infrastructure buckling? Either way, fragility exposed. Scientific studies warn solar demand through 2030 may meet only 62 to 70% of needs, requiring 10,000 to 14,000 tons yearly. Recycling can't bridge. New mines lag due to byproduct dependency. This isn't cyclical tightness, it's persistent shortage. Industrial fabrication hits record 680.5 million ounces in 2024, up 11%, surpassing 700 million in 2025, 58% of total demand. Price inelastic. At $100, solar makers don't halt. No substitute matches silver's conductivity. Copper's inferior, gold's costlier. Anything with an on-off switch needs silver. That's the verdict. Compared to historical crises, 1980s speculative bubble burst because it ignored industrial realities. Now, industries drive the squeeze. Millions of panels, EVs, devices competing for metal the hunts once hoarded singly. 2011's rally faded on temporary fears. Today's rooted in permanent shifts like EV mandates in Europe, China leading production. Even if economy slows, demand doesn't vanish. Clean energy targets lock it in. Analysts diverge. CPM Group sees 206 million ounce deficit for 2025. Others, 117 to 149 million. But cumulative 800 million? Undeniable math. Stockout risk looms. Exchanges impaired by low inventories. Here's a point of interpretation. If you're in renewables or manufacturing, how do these deficit projections align with your supply chain realities? Write your take in the comments, particularly on thrifting limits or substitution attempts. The narrative twists. What seemed monetary, Fed easing, reveals industrial undercurrents. Rate cuts accelerate, but deficits predated them. Manipulations end in 2020. Convictions cleared the path. But true catalyst? Energy transitions hunger. Solar from 232 million ounces in 2024 to 261 in 2025. EVs pushing automotive to 90 million. Add IoT billions of devices, each with trace silver. Geopolitically, China's export ban isn't isolation. It's strategic hoarding for domestic solar dominance. India's cultural pull. Affordable silver for masses, now industrial too, as they build capacity. U.S. critical list? Ties to military. Silver and control systems, perhaps unspoken in hypersonics or cyber infrastructure. Logistics strain. Funds like Kotak Mahindra halting investments, can't source metal. This silence from regulators? Another signal. Oversight lags the brake. Deeper. Systems loss of control manifests in anomalies like Chinese inventories at decade lows or global recycling unable to offset. Mine output flat, despite prices. Byproduct curse. Past sustainability assumed endless vaults. Now, drainage exposes the lie. Wealth transfer unfolds here, from paper holders eroded by 3% inflation to hard asset owners. Silver up 120%, gold 60%. Outperformance not luck, but leverage in a smaller market. Projections. Bank of America at $65, already surpassed. PNP Paribas, eyeing $100 in 2026. First Majestic's Keith Neumeyer at $100 to $130. Bears warn of pullbacks, demand softening in recession. Valid. Volatility defines silver. But alignment's rare. Deficits, drawdowns, demand explosion, policy support, manipulation's ghost faded. If you've invested in silver ETFs or physical, How has this ratio shift from 80 to 65 affected your strategy or expectations? Drop your insights in the comments, especially on whether it feels like catch-up or overshoot. Non-linearly, circle back. $67 isn't the story. It's the symptom of 45 years ceiling shattered from sub-$50 stasis. Why now? Because controls that worked in abundance fail in scarcity. Spoofing thrived 2008 to 2016. Post-convictions, scrutiny tightens, but physical void trumps. Industrial inelasticity, 700 million ounces needed regardless. Geopolitical hoarding, China keeps processed silver home. Logistical chokes, Indian suspensions. Military undertones, critical mineral status, hints at defense stockpiling, unspoken. Historical mirror, 1980s artificial high needed tripling to match inflation adjusted. Today, organic drivers suggest potential beyond. The process deepens. Inventories not just low, allocated, with ETFs claiming hundreds of millions. Lease rates elevated post-spike, sustained pressure. Deficits projected ongoing, 2025 at 206 million max. Cumulative 800 million? A year's supply erased, irreplaceable fast. This where sustainability fractures. Clean energy goals demand silver we can't supply. Studies show 62 to 70% coverage by 2030. Gap unfillable. Recycling boosts, but marginal. New mines? Years away. Byproduct limited. For those in mining or commodities, does this byproduct dependency feel like the core vulnerability now? Share your field experience in the comments on how base metal cycles are dictating silver's fate. Wealth dynamics. Transfer isn't hype. It's observable. Fed's $40 billion buys inject liquidity, debasing fiat. Real yields near zero push to tangibles. Silver is vehicle. Scarce, essential. From 1970s, de-standardization to now. Patterns repeat, but amplified by industrial lock-in. Post-2008 saw rallies. This eclipses. Not all agree. Stretched valuations, potential recycling surge. Yet factors stack. 5 deficits, 800 million shortfall, 261 million solar, 90 million auto, inflation sticky, rates down. Unexpected tie? COMEX glitch amid deliveries. Fragility in infrastructure built for stability. Media tiptoes, regulators silent, signals of avoidance. If you're following exchange data closely, what anomalies have you spotted in recent deliveries or spreads? Let me know in the comments, as it could refine this picture. Endgame sharpens. Phase of rupture, not reversal yet. Silver at $67 marks entry into uncharted scarcity. Process ongoing. Deficits compound. Demands entrench. Controls erode. Scale emerges. Not just market shift, but systemic pivot, where a once monetary metal becomes industrial linchpin, pulling wealth along fractures. No endpoint visible, only acceleration. If this resonates with your own market watches, how do you see the wealth transfer playing out in your context? Write it in the comments to build the collective view. Silver sits at $66.50 per ounce. Not a correction. A consolidation after breaching $66.87 2 days ago. The highest nominal print ever recorded. Year-to-date gains exceed 126%, doubling from the $29 level at January's open. COMEX registered stocks hover near multi-year extremes, while global ETF holdings climbed to 1.13 billion ounces after 95 million ounces of inflows in the first half alone, more than all of 2024 combined. Industrial offtake hits record 680 million ounces last year, projected over 700 million now, with solar alone at 261 million and automotive pushing toward 90 million. This isn't retracement. This is the market digesting a structural deficit that reached 149 million ounces for 2025, the 5th consecutive year of shortfall, cumulative drain nearing 1 billion ounces since 2021. The system no longer masks the gap, it broadcasts it. Trace the fracture lines further. Mine production stalls at 820 to 850 million ounces annually, incapable of response because 70% arrives as byproduct. Copper, zinc, lead decisions dictate silver fate. When base metal economics stall expansions, silver supply freezes. Thrifting in solar cells drops from 500 milligrams to 111 milligrams per unit. Yet total consumption surges fourfold in a decade because deployment scales overwhelm efficiency. China adds 45% solar capacity last year, subsidizes another round. India electrifies rails and builds panels domestically. Electric vehicles embed 25 to 50 grams each, 2 to 3 times combustion engines. Global fleets shift, demand locks in. No substitute replicates silver's conductivity at scale. Copper lacks efficiency. Gold costs prohibit. Industrial use turns price inelastic. Manufacturers absorb $100 if needed because alternatives don't exist. This rigidity marks the pivot. What once buffered speculation now enforces scarcity. Monetary currents converge. Federal Reserve's easing cycle, 3 cuts this year, balance sheet expansion resuming, keeps real yields suppressed as inflation holds above target through 2028. Liquidity floods hard assets. Gold rises 60% to $4,300 range, but silver's smaller market amplifies flows. Gold-silver ratio compresses toward 65 to 68, down from 80 plus earlier, signaling silver's accelerated catch-up. Historical parallels sharpen the view. 1980s $49.45, peak equated to 140 to 185 inflation adjusted today, driven by pure speculation that collapsed on rule changes. 2011's $48 run faded on tapering stimulus. Today's foundation differs. Irreversible industrial anchors prevent symmetric unwind. Even recession risks soften demand marginally. Clean energy mandates and grid upgrades persist. If you've navigated these ratio swings before, how does this compression feel against past cycles? Share your read in the comments, particularly on whether it signals sustained outperformance or temporary momentum. Geopolitical vectors tighten the coil. U.S. critical minerals designation elevates silver alongside rare earths. Strategic vulnerability acknowledged. China's processing dominance pairs with export restrictions, securing domestic needs amid solar leadership. Tariff echoes earlier this year triggered COMEX builds to record 531 million ounces as metal rushed stateside. Now flows reverse toward London shortages, exposing arbitrage fragility. Indian consumption accelerates. ETFs, triple gold inflows. Cultural affordability meets industrial buildup. Data centers for AI demand silver in thermal systems. 5G infrastructure embeds it permanently. Military layers remain understated. High-frequency components, sensors, antimicrobial applications in field medicine. Disrupt one node, say, Chinese supply chains, and ripples hit defense, energy, logistics simultaneously. Regulators quiet on tightening inventories, not oversight. Recognition that intervention risks accelerating the break. Invert the timeline. Symptoms preceded policy shifts. Deficits built pre-easing. Industrial hunger predated ETF surges. Manipulations documented era. JP Morgan's convictions, cross-bank fines, ended, removing downward pressure exactly when physical voids emerged. Paper once drowned physical signals. Now vaults empty faster than contracts fill. Lease rates, though off 39% peaks, remain elevated. Borrowing costs reflect allocation, not abundance. Exchange glitches amid delivery stands widen spreads, highlight infrastructure strain. Scientific projections warn. Solar through 2030 covers 62 to 70% of needs at best. Gaps unbridgeable by timely recycling or mines. This isn't forecast. It's trajectory already embedded. Wealth mechanics clarify. Fiat expansion erodes paper holdings. Hard assets capture purchasing power. Silver's dual role, monetary hedge plus industrial essential, positions it as transfer conduit. From post-gold standard 1970s to post-2008, patterns recur, but amplified here by green transition lock-in. Analysts split. BNP Paribas eyes $100 in 2026 on deficits and revolution alignment. Others caution valuation stretch, potential recycling ramps if prices sustain. Both hold weight. Volatility inherent, pullbacks probable. Yet stacked factors rare. Multi-year deficits, inventory extremes, demand irreversibility, policy support, investment acceleration. If you're sourcing physical or tracking deliveries, what shifts have you seen in premiums or availability lately? Drop your observations in the comments to sharpen the view. Deeper exposure reveals systems' adaptive failures. Past rallies relied on speculation detachable at peaks. Current one embeds in production chains. Solar's 261 million ounces aren't optional. Panels fail without conductive paste. EVs extra grams per vehicle compound fleet-wide. IoT devices tally billions, each trace adding up. Emerging markets don't retreat. Rising incomes sustain jewelry, investment pulls. China's ban isn't temporary. Supply security for manufacturing hegemony. U.S. list ties to national security, hinting stockpiling beyond public data. Logistical signals persist. Funds halting inflows earlier, now resumed amid scarcity pricing. Circle to scale, $66.50 marks, not plateau, but integration phase. Process compounds. Deficits roll forward, demands entrench deeper, controls dissipate further. Wealth flows accelerate along exposed fractures, from debased currency to scarce essential. No reversal horizon yet, only deepening imbalance. If this alignment matches your sector signals, renewables, electronics, finance, how do you weigh the inelastic demand against macro risks? Write your perspective in the comments for collective calibration. Unexpected convergence. COMEX records mask allocated metal. ETFs claim chunks, industrials hedge forward. True availability thinner than headlines. Media frames as investment driven. Fundamentals anchor it. Ratio at 65 to 68, nears levels preceding silver overshoots historically. Projections diverge. $70 breakthrough possible next year, or consolidation if growth falters. Alignment endures. For those in ETFs or physical allocation, has this year's inflow pace changed your positioning timing? Share in the comments if you've adjusted on ratio moves. Phase solidifies. Rupture evolves into new equilibrium. Higher, tighter. Silver demands recognition, not as relic, but linchpin. Process irreversible. Scarcity compounds. System adjusts upward. Scale vast. Generational pivot where industrial necessity overrides monetary inertia. Observation clear. The transfer proceeds. Measured, unrelenting. If you've witnessed similar systemic shifts before, what parallels or divergences stand out here? Let it surface in the comments. Final fracture. Not speculation's end, but abundance illusions. $66.50 embeds the signal. Finite resource meets infinite mandate. No climax visible, only continuation. If you're mapping clean energy chains, does the projected 2030 gap feel imminent from your end? Contribute your frontline read in the comments to anchor the analysis. Silver holds at $66 per ounce, not a peak, a threshold crossed, with year-to-date gains exceeding 127% from $29. Cumulative deficits approach 1 billion ounces since 2021, the fifth straight year of structural shortfall. Industrial demand remains locked above 680 million ounces annually. Solar and EVs embedding consumption no price can dislodge. COMEX vaults show record totals, yet allocated, spoken for by ETFs, hedges, industrials, leaving true availability thinner than ever. The system has shifted. Abundance illusion dissolved, scarcity entrenched. Trace the final fracture. Past controls, paper overlays, byproduct supply elasticity, collapse under irreversible needs. China's export locks, U.S. critical designation, emerging market pulls compound the void. Monetary easing sustains liquidity chase. Real yields suppressed, wealth flows from fiat to tangible. Gold-silver ratio near 65 to 68 signals silver's sustained leverage in a smaller, tighter market. Historical rallies unwound on speculation alone. This one anchors in production chains. Panels, vehicles, grids, devices demanding metal regardless. The process concludes its rupture phase. Deficits persist. Inventories mask allocation strains. Demands deepen without retreat. Wealth transfer accelerates along these lines, from eroded paper to essential hard asset. No reversal in sight, only consolidation at higher equilibrium. Scale fixed. Silver no longer peripheral monetary relic, but core industrial pivot in energy, tech, defense chains. If you've tracked this year's physical flows or premium shifts, how does the current tightness align with your direct observations? Share in the comments to close the view. Phase complete. System lost control, where physical reality overrode mechanisms built for surplus. $66 embeds the new baseline. Finite resource against permanent mandate. Continuation inevitable, unrelenting. If this endpoint matches your long-term signals, what final divergence or confirmation stands out? Let it land in the comments.